Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Hillary Martin, who is a Certified Financial Planner, or CFP, and it's supposed to have a registered mark on there. Anyway, Hillary works with the Family Wealth Consulting Group. She is a fee-only financial planner. Hillary has a BS in economics from Santa Clara University, which she received in 1998. She took the CFP coursework at UC Santa Cruz and received her CFP credential in 2010. So welcome, new CFP.
Thank you.
And she's currently working on an MBA in finance at Santa Clara University. Hillary is a partner and financial advisor at the Family Wealth Consulting Group, where she has worked for 5 years. So today, Hillary and I are going to be talking about should you convert a regular IRA to a Roth account. Now, this is a topic that's sort of a hot topic for 2010 because of some changes we're going to be talking about. And before we get started, I'm going to give a caution, and that is that this is a complex tax area, and the answers to some degree are going to vary from individual to individual. So you need to get advice from a professional tax advisor. This is just an introduction to a conversation that we hope that you'll be continuing with your advisor. So with that, let's get started with our questions.
Great.
Okay. So first, Hillary, why are people talking about converting regular individual retirement accounts, or IRAs, to Roth IRAs?
The reason is because in 2010, the IRS lifted a restriction that previously kept most people from doing these types of conversions. So it's new.
Mm-hmm.
And if you choose to convert a traditional retirement account to a Roth account, you're going to pay income tax on the amount of money that you convert. But in 2010 only, unless you elect to pay all the tax in 2010, the income tax will be split between tax years 2011 and 2012. You may still choose to pay the tax in 2010, and you could do that if you feel like your marginal tax bracket that you're in is going to increase in 2011 and 2012, but you have the ability to split it between those 2 years. And converting a traditional retirement account to a Roth IRA is a good way to build up a Roth IRA account with a high balance, because the most you can contribute to a Roth IRA account in any year is $5,000 if you're allowed to contribute at all.
Yeah, so you could have this little dinky account that you can't really do very much with, but if you can build that account up $100,000, $50,000, it opens up the types of investments that you can get involved with that account.
Yeah, it opens up the types of investments and the benefits that you can receive from having a Roth IRA, especially over time. If you can just let that money grow, then the power of compounding helps you out.
Right. Okay, what are some advantages of having a Roth account as compared to a regular IRA?
So unlike a regular retirement account, when you take distributions from a Roth IRA, you don't pay income tax on the distributions. You pay income tax when the money goes in and not when it comes out. So a lot of people see that as a big advantage, and especially if your tax bracket in later years is going to be higher.
Right. So...
Oh, there's one other benefit. During the owner's lifetime, there are no distributions required. If you have an IRA, you're required to take distributions from that IRA after you reach age 70 and a half based on your life expectancy. But for a Roth IRA, you can maintain the balance for your entire lifetime.
Right. So here you are with this Roth account again. A lot of us were looking for a tax break. They're thinking of, I want to get this tax deduction so that I can reduce my tax bill. Mm-hmm. This Roth account, in a sense, is counterintuitive for that, because you're not getting the subsidy where the government, in a sense, is paying back part of your contribution to the account. Instead, what's happening is you're getting an account that will grow tax-free, so on the other end, not so much, or no taxable income will be coming out. And so it's a totally different paradigm, if you will, totally different model of retirement savings. And again, the ability, as you said, to have the account continue to grow tax-free when you don't even have to take a distribution, that's kind of exciting for some people that, they have enough assets already. They don't need any additional income maybe for their retirement because they may have other investments that they've made that are outside or what have you. May even have a retirement account with their employer. But here they've got this account that they can make grow and grow. And when you keep compounding, as you said, then that enables you to continue to have that account grow significantly. Whereas with an IRA, you have to take it down. And so when you start, of course, reducing the principal in the account eventually, then that's going to reduce the additional earnings that you can have from that fund.
That's right.
Yeah. Okay. Why don't you please explain the 5-year rule as it relates to Roth accounts?
Sure. The 5-year rule says that once you open and begin to contribute to a Roth or convert a traditional retirement account to a Roth IRA, you can't take distributions from that account until you've had it for 5 years. And that's even if you're after age 59 and a half. And that's basically to prevent people from converting traditional retirement accounts to a Roth IRA to avoid the 10% penalty, and also to avoid the taxation of accumulated income.
Right. Thank you for that.
But you don't have to worry about it if you're over age 59 and a half.
You don't have to worry about the 5-year rule if you're over 59 and a half?
That's right.
Okay. Now, what kinds of accounts can be converted?
Almost all of them. You can convert regular IRAs. You can convert SEPs, 401ks, 403bs, profit-sharing plans, money purchase pensions, and employee stock ownership plans.
ESOPs.
But you cannot convert inherited IRAs.
Right. So inherited IRAs, for the most part, you can't do. They're one of my questions. Okay. But anyway, but let's talk about the inherited IRA for a minute. So because we just made a generalization that you can't convert an inherited IRA, but that's not always true. So when can you convert?
You can convert and inherit. So if you are the surviving spouse and you've inherited the IRA, you can convert the IRA to your own name and then convert it to a Roth.
Right.
Or if you've inherited a 401k, you can convert directly without rolling it over to an IRA.
Right. So that was a new ruling that came out fairly recently on the 401k that really surprised a lot of tax advisors, because usually you think that you have to go through this intermediate step. In other words, if you can't convert an IRA, it doesn't seem like you should be able to convert a 401k, but basically the IRS ruled that you can, so that means we can. And so that's kind of an exciting choice, but it means that you need to be aware of it when you inherit one of these 401k accounts, so that you don't accidentally do the wrong thing, because you need to make this direct transfer.
Oh, you need to be very careful.
Yeah.
The rules are very particular.
Yeah.
I wouldn't work without the guidance of a professional personally.
Okay. Okay. So let's talk about the income limits that apply